Good afternoon. How's everybody doing? Hey, this is Craig Modelmog with Cornerstone Wealth Management. This is Wall Street X's and O's. Welcome. It's hard to believe we are at the end of July. I say this every time I know. Time just flies by. So you know what? You better make the most of it because it's going to fly whether you are making the most of it or not. So today is Friday, July 29th, actually. August 1st is Monday. Monday. Wow. See, for those of you that are joining me for the first time, this is uncut and unedited. I have just now proven that it is uncut and unedited because, you know what, sometimes it just doesn't go right, but it's okay. It's okay. We make mistakes. You know what, no one is perfect, and life goes on. Before I get rolling here, you know how we have to do this thing. We've got to kick off the day or the episode with the lovely disclosure, which I will go over. Just for those of you, again, joining the first time, there will be a quiz at the end of this, so please get out your Scantron and your number 2 pencil because you will be tested over this disclosure. Once again, I got you. Anyway, hey, what I would like to say is all of the information on this show is believed to be true. I'll tell you it is because I've researched it and I'm very big on truths and facts. But anyway, it's believed to be true. This is not a solicitation to buy and or sell anything, including securities, including investment advice, including asset allocation advice, including legal advice, including tax advice. This is for informational purposes only. Investments can and will lose money, and they're not FDIC insured. And for those of you that would prefer to read the remainder of this, I will give you 1 second to do that. Moving on. I got a really good show today. We're going to talk about bear market bounces and how does 2022 stack up compared to some of the most recent ones, that being the financial the global financial crisis in 2008, and then the tech wreck, the dot bomb, whatever you want to call it, from 2001 and 2. We're going to talk about the US dollar strength, which is something that really doesn't get a lot of airtime, but it's more, what does it mean? I'm really going to dive into that here today. And then we're also going to kind of hit, beans we're in the midst of Q2 earnings season, kind of what earnings are telling us. And we're going to wrap it up today, as always, with things that make you go, and these are good. I have some good ones today. Anyway, next slide. Moving on, bear market bounces. Like I said, we're going to look at the 2 most recent. So we're looking at 2008, which is a great financial crisis. We are looking at 2000 financial crisis, which is the dot bomb or the tech wreck. It had lots of fantastic names. But what I really want to focus on is, on average, the movements up, as you can see here. And then also downward movements. And you say, well, Craig, what do you mean by that? Well, what I mean is that in the midst of this market going downward, it happens actually the same with markets going up too, but you have moments when you see markets bounce. You know, we have these big, drastic and pretty intense sell-offs, and then you see markets bounce. And I want to go through what these look like, because during periods like this, people can get sucked in. This is not a time to be buying stocks. I'm just telling you that. You know, the all clear signal has not been given. And if it has, it's been given incorrectly. And it's not something you should be buying into, because the economy really is now just in the beginning stages of starting to decelerate. And I'm going to hit on that more as we get through this. But anyway, if you go back to the 2000 bear market, which lasted from 2001 through 2002, the average move up, as you can see, was 15%, which is pretty nice. Average downturn here was minus 18. If you go to the global financial crisis, that is the beloved GFC. Okay, that is not KYC, as in Kentucky Fried Chicken. This is global financial crisis. Average move up was 12%. Average move down was a little bit more. It was 19%. If you look at the current bear market, a little less volatile. And I would say that the cause of that, at least at this point, has been because we haven't really seen the VIX remain elevated above 30 for that long. For those of you that have joined me in the past, you know, I talk about 3 volatility paradigms: 0 to 20, 20 to 30, and 30 plus. When you get in that 30 plus range, that's where you're going to see these big 18 to 19% plus on average drawdowns. And in my next slide here, I'm going to show you where we've really had some doozies. I do not believe until we get to a more elevated volatility period are we going to see more drastic pullbacks. But let's take a look in this a little bit deeper here. As you can see, the black line is basically from February 2000 through June of 2003. That's how long that bear market lasted. If you look at the global financial crisis, it began in June of 2007 and ended in April of 2009. And then you look at the current one, which is the blue line, where it started in November of 2021, through to date. Here's what's pretty fascinating. You can see some moves, and I'm going to focus here on the tech wreck from 2000 to 2003. Some of these are some big numbers. This is a down 20. This is a down 26, down 32, down 19. Look at these ups though. Up 19, up 21, up 21, up 20. Let me ask you this. In any of these periods where you saw the market peak out, was it a good idea to go diving in and buying stocks? Unless you were doing this last one here, the answer to that is no. If you look at the global financial crisis, this had some doozies. It had a down 34, a plus 23, a down 25, a down 28, a plus 18. Very violent. The global financial crisis, definitely a much greater elevated VIX, and you can see that by these downdrafts. Compare and contrast, you look at our current bear market and you see a down 10, down 9, down 16, down 12. This here as plus 10. If you look at the last few days, this is probably going to be closer to 14, 15, 16 on this up, plus 7, plus 11. Okay. Here's the deal. You cannot let yourself get sucked in with what I will call the FOMO, fear of missing out. That is the great killer when it comes to investing, where you think, oh man, the market's sold off enough, it's got to be bottoming, right? Right? Doesn't it? That's what people say. Oh, we're off, 20%, we're off 15%, we're off fill in the blank. It's not a time to get complacent and just think because the markets have sold off that everything is done and over with, because in many ways it's not. Also look at longevity as far as how long bear markets have lasted. And you can see if we're in a baseball, I'm a sports guy, so I'm going to talk, we're going to talk baseball analogies here today. If you look at when this bear market ended here and here, you're looking at from February of 2000 through June of 2003. That's a very long time. If you look at then the global financial crisis, June of 07 through April of 09, I mean, we're looking at almost 2 years there. Here you're looking at, almost 3 years, not too short from 3 years. Here on the current, we're going November 21st through to date. So that is through July, that's 8 months. Most likely we still have some more time on this. What is it going to look like from this point on? I have no clue. No one does out there. The key is you've got to continue to focus on the data, continue to look at what's happening, look at all the different variables that are out there that you hear me talk about on a regular basis. You've got to keep your eyes poised on those things, because I tell you, sometimes it's not a good thing always to react with your gut. I talk a lot about not investing emotionally. That's a really bad thing, and I'm going to continue to encourage you on that. So right now, I think it's a hurry up and wait type of situation, because things are kind of just starting to get ramped up economically speaking. Let's move on here. Number 2 here, U.S. dollar strength. This is interesting. Currently, the U.S. dollar is technically overvalued, meaning it's risen versus all these other major global currencies, of which it's overvalued for 32 of the 33 major currencies that are measured. Can you guess which currency is stronger than the US right now? And I'm going to sit back and listen. We'll listen to some Jeopardy music in our brains. So I don't even have to sing it, and it's probably already going in your head. You know what the answer to this is? Russia. How crazy is that? Of course, it did sell off. When they first invaded Ukraine, the Russian ruble went down 150%. So, there's always, you have to look and really see what the driving factors are at. But still, nonetheless, the US dollar is incredibly strong, and that's something to pay attention to. Next slide. It's beginning to start to look like a textbook deflationary period. What do I mean by that? Is when you enter an economic period where growth is beginning to slow, okay, which that is happening. We are just experienced our second quarter of negative GDP, okay, and we now have the White House and other talking heads, Janet Yellen, Fed Chair Powell, talking how, well, it's not necessarily a recession, because the labor market is so strong, or because of this, whatever. You know what? I know how historically they've measured it, and it is what it is. But when you add a economy that is decelerating and inflation that's beginning to recede, and that's what's starting to happen. It's kind of ironic that we're in the midst of this massive rate hike policy focal point, and we're starting to see the inflationary numbers recede. That's the number I'm looking, or the word I'm looking for. When you see those coming in combination together, okay? Because if you think about it, there's four different things that could happen with the economy. It's either going up or down, and inflation's either going up and down. So with those two things, you have four different potential combinations. When you have a combination of growth and inflation that are decelerating, what you tend to see historically is continued strength in the US dollar, and you also see the long end of the yield curve begin to recede. We're going to put a check there, and then you also have the yield curve that inverts. That is another thing that we have right now. So when I say textbook, it really is really playing into exactly what I would anticipate. So during those times, is there anything in there that makes you want to own stocks? No, stocks tend to not perform well. The stocks that tend to hold up better are things like utilities, like staples, things that pay dividends. Those are the things, it's high quality balance sheets, it's high quality cash flows, it's things like that that will hold up better. It doesn't mean you're going to be immune to the drop, the pullback, because you won't, okay? Question here, how many countries, going into that inverted yield curve, how many countries' bond markets around the world currently have an inverted yield curve? I'll give you a few more seconds here of Jeopardy music, and then I'm going to tell you. Nope, not just one. 15. There's 15 that are currently totally inverted. If you look at this list, Chile, the Czech Republic, Poland, Iceland, Canada, Sweden, the US, Qatar, Turkey, Hungary, Pakistan, Brazil, Mexico, Romania, Ukraine, no shocker there. Partially inverted, Hong Kong, the UK, Namibia, that's in Africa, UK, Hong Kong. You look at over here on these here, they are minimally inverted. That means they have partial parts of the yield curve that are inverted, but not all of it. We've got another good list: Singapore, Switzerland, Germany, Austria, Belgium, France, Spain, lots of Europe, Cyprus, Serbia, Russia. I'm not even going to try to pronounce that last one because I just can't figure out what that is. But Mauritius, and I probably killed it. And see, once again, you see my imperfections. But anyway, what this tells me is there are lots of economies around the globe that are not healthy. Again, we've got global pressures from an inflationary standpoint, and you see that directly related to the yield curve, or definitely one place that is related here. Let's move on. Future earnings, this is a good one. As you can see, all securities, there's 264 or 498 companies that have already posted earnings. On average, sales growth is up 9.6%. Look at earnings. Do you hear that on the news? Apple posted earnings yesterday. They had 2% growth. When's the last time you saw Apple grow by 2% and everyone's happy? Golf clap that one. I'm so happy. Let's buy stocks. No, let's not. Bigger thing, tech year to date is negative in earnings growth. Consumer discretionary is down 16.9%. Communications is down 8.76%. And Financials, that's banks getting crushed, down 25.51. It's not great out there. And the problem is we are entering a profit recession, which we have not had since 2008. And that does not bode well for stocks. I'm just telling you. Last one is, and I just let the cat out of the bag, was in 2008. Current data right now that I'm measuring and mapping every day says we're going to have at least 3/4 of declining profits and could have as many as 5. But right now I'm really putting my stake on the ground on 3, and I'm going to stick with that for now. Recently, AT&T, when they came out, they said people are struggling paying their cell phone bills. That's not good. Walmart came out earlier in the week and says that they guided lower for their Q2 earnings, which they have not released, but they want to kind of take the luster off of it, or dampen the how they're going to get killed in the market. The stock dropped over 10% in a day, and they're saying people's purchasing habits are changing. Why? Because things are a lot more expensive. So when things get more expensive, people spend differently. Procter & Gamble came out and said that there are significant headwinds in the coming months/quarters. Why? Commodity prices are a huge challenge. Inflation is not going away anytime soon, and it is going to remain stubbornly elevated. I prefer to call it sticky. What I find amazing is how Wall Street is playing the typical shell game, where the various talking heads out there are all talking about, oh, well, it's really not as bad as it is, or, it's pretty good. Like I mentioned earlier, Apple yesterday posted a 2% increase, and it's like it's given the all clear sign. Here's the deal, people. I am not buying it, and I encourage you not to buy it either. Moving on, things that make you go, I got some good ones today. Wage growth. This is interesting. This thing here that I'm tracing very poorly might be it. Okay. This is 16 to 24-year-olds. Essentially, as college pricing, or the cost of going to college, has risen, you've seen a lot of people opt out of going to college and go into the workforce. Thus, they're making up a pretty big chunk of it. You can go back and you can see here, you go back to the global financial crisis on kind of what happened as well. And it was kind of similar where, people were really thinking that, we're going to, at that point in time, it was the opposite, where they're like, man, we want to get out of the workforce and go to college because I want to try to give myself more opportunities, more job prospects, the ability to make more money. During this global pandemic, you've seen the flip side of that, where now you've got a lot of young people now that are going into the work world because college tuitions are high, because there's so many sinking jobs that still are unfilled. I've seen there's anywhere up from 4 to 4.5 million jobs that just vanished during the pandemic that have not come back. So we really don't have a super healthy labor force right now, and thus we see it in the age of our workers. Next one, American patriotism. This is good, dips to a new low. You can see the dark line is extremely proud. It has dropped to only 38% of Americans that were polled in this, which is a Gallup poll, said that they are extremely proud to be an American. And now I've got that song humming in my mind. Overall here, or if you combine extremely proud with very proud, you get up to 65, but the extremely proud definitely has dropped. Another different way of looking at it, you've got our two political parties here. You've got the red line as Republican. You've got the dark line being Democrat, and the dotted line is independent. This also is not a shocker. Why? If you look at the two platforms that either party has, and you can see why one party's is higher than the other, because that's, again, kind of what they're putting their stake in the ground on. This is what we're about, and you basically hear that's what their narrative is. These numbers really do not surprise me in the least. And that's all I got. Today was a good one. I thought I was going to be quick today, and I'm still yapping here at 19 minutes later. But anyway, in closing, I don't want you to take my what I say negatively leaning message today to heart. I'm not saying anything other than just looking at the facts. I'm a big have a big focal point on truths and talking about the facts. Here's what I do know. This is fact. I have great confidence in this country. I am actually very proud to be an American. I tell you that this is the hands down best country on the planet to live in, despite our challenges. But that's the beauty of being in a free market like we are so blessed to live in here, is that we actually get to make choices. And sometimes people don't make good choices. But the nice thing is we have the right to make not good choices from either side of the perspective. And that's what makes this so great. I have great confidence in corporate America. And I know that corporate America is going to get through this current economic pullback. It is nothing different than we've ever experienced in the past. There are some similarities, there are some differences, but I know that corporate America will get through this, and we will get through this just like any other downturn like we've had historically. The kicker is you got to be patient, and you got to wait until things begin to improve and things begin to reverse the negative trend into a positive trend before you start going back in the pool. It's like going swimming at the ocean. A couple years ago, we took a little getaway for a long weekend, went to Huntington Beach, California. Right when we show up, everyone's out of the water because they had spotted a couple great white sharks in the water. My son proceeded to be angry and walked down the beach to a beach further down the line that was not having people stay out of the water so he could get in the ocean. For me, that's not good enough. I'm going to wait and be patient and make sure there are no sharks in the water. And in honor of Shark Week that's going on right now, National Geographic, I watch sharks every night. So anyway, thanks for coming. Hope you had a good time. I know I did always. And it's always great to see you all. So take care of yourselves. God bless you all. Have a fantastic weekend. And until next time, this is Craig Modelmog again for Wall Street X's and O's, and I am